Hey everyone, and welcome to this explainer. Today, we're going to be looking at the absolute foundational mechanics of financial statements, and we're doing it by examining business finances through two entirely different lenses. You know, it's fascinating. You can look at the exact same company, the exact same series of events, and depending on which lens you have on, the financial reality is going to look drastically different. Those two lenses are cash accounting and accrual accounting.
Okay, let's dive into this with a bit of a rhetorical puzzle. I want you to ask yourself, when exactly does a financial transaction actually happen? On the surface, right? It seems incredibly obvious. You buy something, you pay for it, transaction complete, boom. But in the real world of business, the timing of an action and the timing of a payment rarely happen in perfect harmony, and that creates a massive dilemma for anyone trying to keep an accurate ledger.
Section 1. When does money count? The core puzzle of business timing.
Moving right along to Section 2, the cash basis explained. This is the simplest form of accounting. Now, this is arguably the most intuitive method for most of us. By definition, in the cash basis of accounting, entries are recorded only when cash is actually received or paid. It's incredibly straightforward. If physical cash, or a digital transfer, doesn't literally hit your bank account, it doesn't go in the books. Basically, if you can't touch the cash, it didn't happen in this system.
But here's the catch. Because it's so literal, this method completely ignores certain delayed transactions when you're preparing final accounts. The cash basis totally ignores incomes that you've earned but just haven't received yet. That's your accrued income. It also completely ignores expenses you've definitely incurred but just haven't gotten around to paying yet, which are outstanding expenses. If the cash hasn't moved, the ledger just stays blank. Think about the frustration of working your tail off all month, but because the client hasn't paid the invoice yet, on paper, your business looks like it did absolutely nothing. That is the blind spot of the cash basis.
Which brings us to Section 3, the accrual basis explained. We're shifting our perspective here.
So let's put on our second lens. Now, what's really interesting about this slide is that historically, the accrual basis is known as the mercantile system. Instead of obsessing over cash, it records the financial effects of transactions in the specific period they physically occur. It recognizes a fundamental truth of commerce. Buying and selling rarely align perfectly with cash flows. This system attempts to perfectly match your revenues and expenses to the exact year they were actually earned or incurred. And yeah, that sometimes comes with the very relatable pain of having to pay taxes on money you've earned but haven't technically received in cash yet.
Now, because we aren't just blindly following the cash trail anymore, this accrual system requires a few specific adjustments in the final accounts to make sure operations actually match reality. You have to account for prepaid expenses. That's where you paid early but haven't gotten the benefit yet. You've got to adjust for outstanding expenses, where you got the benefit but haven't paid. And you have to adjust for income received in advance. These three adjustments, they're basically the secret sauce to making the mercantile system work. All right, let's move to Section 4 and see how this builds. A tale of two ledgers, the scenario test.
Let's put both methods to the test chronologically, walking through a very common transaction that spans across two different calendar years. Imagine renting an office space. In December 2017, you occupy the office. You are in there, enjoying the benefit of that accommodation all month long. But the actual cash payment isn't handed over to the landlord until January of 2018.
So here is the ultimate test. Based on the two sets of rules we just discussed, in which year's profit and loss account does that rent expense truly belong? Does it belong in 2017 when you actually used the space, or in 2018 when you finally opened your wallet? Take a quick second to guess the outcome for both systems.
Okay, here's how it breaks down side by side. If you are using the cash basis, that rent expense is recorded strictly in your 2018 profit and loss account, simply because the cash was paid in 2018. The system does not care one bit that you sat in the office in December. But look at the accrual basis. Under this mercantile system, the expense is recorded in the 2017 profit and loss account. Why? Because the actual benefit of that rent payment, the use of the accommodation, was fully enjoyed during the year 2017. In the accounting world, the accrual method is considered highly logical because it ties the expense directly to the actual operational reality of the business.
Section 5. Which method wins? Time for the verdict.
So the crucial point is this. When we look at these two contrasting systems operating in the real world, the primary difference lies entirely in the timing of recognition.
The cash system demands a literal exchange before it recognizes anything. The accrual system, on the other hand, recognizes these elements the moment the transaction physically occurs, and its effects are measurable, regardless of where the money is at that exact second.
Because it provides a much more accurate, holistic picture of a company's operational reality, most enterprises in practice adopt the accrual basis of accounting. It is, without a doubt, the undisputed industry standard for businesses that want a true reflection of their financial performance over a specific period. And this brilliantly illustrates our final takeaway. The next time you look at a financial statement, I want you to ask yourself, does this ledger merely reflect the chaotic timing of cash movements, or does it show the true logical health and operations of the business? Understanding that difference completely changes how you evaluate a company's success. Thanks for joining me on this explainer, and I'll catch you next time.